Welcome to another episode of Tax Talk Unfiltered. As always, I am joined with Rachel Richards, Tal Binder, and I am Spencer Carroll. We've got an exciting episode for you today. We're talking about something that is a burning question for a lot of our clients. You see it a lot on the internet, YouTube, social media, the idea of an S-Corp. And is that right for you? Is it right for your business? Will it actually save you thousands of dollars in taxes? It's a complex topic. It really depends on your situation. We're just going to get into an introduction today, but we are excited to talk about it, and we're going to kick it over to Tal to start us off. He's going to give us a brief history of the S-Corp, and then Rachel's going to tell us what exactly an S-Corp is. So Tal, we'll start with you.
Before I get started, I have two suggestions actually. Number one, we should really choose another name for this podcast. That's the number one thing. But the number two, before I get into the history of I don't know, something is not rolling through my tongue. I don't know. But number two, maybe before I get started with the history and bore most people about it, maybe Rachel, do you want to tell us what an S-Corp is?
All right. So an S-Corp is a business structure that allows corporations to avoid double taxation and LLCs and partnerships to minimize their self-employment tax. One thing that's commonly confused is an S-Corporation is a tax election. It's not an actual type of business entity. So you can't open an S-Corp, but you can open a business that will be taxed as an S-Corp. So you would start with an LLC, a corporation, or partnership, and make an election to be taxed as an S-Corporation with the IRS. The reason that the S-Corporations are so attractive is that at the S-Corp level, you don't pay any federal corporate income tax. So instead, your profits and losses flow down to the owners, and the owners pay tax for the business income or get a benefit from the losses at their individual tax rate. So it avoids the double taxation that you have as a C corporation, and compared to a partnership or a single member LLC taxed as a disregarded entity, instead of having 100% of your profits subject to self-employment tax and income tax, you get to reduce and control really the amount of profits that are subject to FICA. So Social Security, Medicare, those payroll taxes. And the S-Corp profits are only subject to income tax. But we'll get into those details a little bit later.
Rachel, question for you, because this is something that I've wondered about myself. If you're someone who thinks that your business should be taxed as an S-Corp, like you said, an S-Corp isn't really the entity. It's either an LLC taxed as an S-Corp or a corporation taxed as an S-Corp. So if you think you should be an S-Corp, how do you know whether you should be an LLC taxed as an S-Corp or a corporation taxed as an S-Corp, or does it matter?
It depends. It depends on what's important to you. LLCs definitely give you the most flexibility. So if you're an LLC, you can really be taxed as anything. If you form an LLC and you think you're going to do really well, but things don't pan out, you go in a different direction, you can keep that LLC and have really low compliance costs without too much of an obligation. You don't have to file a separate tax return as long as you meet the criteria to be a disregarded entity.
And so what you're saying is maybe you become an S-Corp, but an S-Corp may not be the right answer forever. And so you can revoke your S-Corp election, go back to the LLC and change things, where I would imagine if you're a corporation and you need to revoke the S-Corp election, that's just your only option is now you're a C-Corp. And you may not
so if you are organized as a corporation, you can either be C Corp or S Corp. But if you form a corporation, you do have stock, where even though as an LLC you're filing an S Corp tax return, that doesn't mean that you have stock. You still have an ownership interest in the company. So if you have a company that you're issuing shares, having those shares is something specific to a corporation.
Tal, I think you wanted to share a little brief history on S-Corps with us.
The fun part, because that's fun for me at least. Actually, S-Corp was created in 1958, specifically for small business owners Back in the day, many years ago, the corporate tax. So when you're a corporation and you're being taxed as a C corp, you have something that's called double taxation. Let's say that you have $100,000 of profit. You will be taxed on the corporate level and pay corporate taxes if it's a C corporation. And then if you want to pull the money out of the corporation, you'll need to give yourself either a W-2 or a dividends. Let's focus on the dividends. You basically withdraw dividends from the corporation, and then you need to pay capital gains, usually, on that amount. And that's something that is very painful from a tax perspective, because it means that you need to pay taxes twice on your profit. Not cool, not fun. Back in 1958, the tax rate for corporations, C corporations specifically, was over 50%. I think it was 52% in certain cases. And then when you pull the money out of the C corporation, the dividend could have been taxed for up to 90%. So it was really,
Oh my God.
yeah, and
Wow.
we get it so good today, people. We get it really good. America is awesome. We're so bad, but it was pretty bad, and that's why in 1958, they basically created the S-Corp in order to relieve that kind of pressure. By the way, it was created before the LLCs. So S-Corp existed before even the legal structure of an LLC even came to life. The LLC, that's another episode. It's at the end of the 1970s was created. But when they created the S-Corp, basically then they introduced the pass-through entity option. Actually, the pass-through entity was with partnership, which is honestly that's the first probably type of entity that was created. But then they introduced basically the pass-through entity option with like the split between the Social Security. I'm not sure if there was Medicare back then, honestly, but that's how they kind of like started. There were more limitations on S-Corps back in the day. You could have only up to 10 partners in the S-Corp. It had to be basically only US residents and citizens, which is still to this day, just like the number of partners changed over time. But that's basically how it started. And over time, till 2004, they updated some of the limitations. But I think that the current law is based on the 2004 reform that passed back then. I think it increased also like the number of people that can be partner of an S-Corp to up to 100, the eligibility of certain trusts to be owners. I'm not sure if that was in 2004 or a bit earlier. But that's some of the kind of like the history of S-Corp.
So what's got me thinking is we have a lot of clients who are business owners, and they come talk to me, to us, and they say that they've been hearing a lot about an S-Corp. They see it on social media. It's supposedly this magical business entity type or election, I guess, that an entity can make. Obviously speaking in very general terms, but like, when should someone start thinking that an S-Corp could be the right choice for them?
I mean, when you're doing well, when you have a profitable business is the time to start thinking about an S corp. Usually when you're starting a business, you have big dreams. You're like, "Oh my God, I'm going to make $10,000 a month." And then reality sometimes can be different than that. So when you are making
$100,000 per month, like, all right.
Exactly. So in order to get the benefits of having an S corp, because there are definitely costs associated with it, you need to be making money. If you're losing money or making, say, $20,000 a year on a side gig, you're welcome to form an S corporation and use one, but you're not going to get any tax benefit. So it's just going to end up being a cost for you. You really want to start thinking about it when you get to a point where the tax benefits are going to outweigh the compliance and maintenance costs.
Got it. And strategically, like, would there ever be a time, you said making money, which makes sense. Once you start making enough money, there's tax saving benefits, but the benefits need to outweigh the costs. Would there ever be a strategic reason, once you've started making money, that an S Corp still would not make sense?
Plenty. I don't think that S-Corp makes sense for the majority of the cases. to that.
The majority, right?
Yeah, for the majority of the cases. S-Corp is great when you don't need to have like other partners with different rules and rights, so you can have only one interest class for an S-Corp. So, for example, if you're going to raise money from somebody, bad idea to have an S-Corp.
S-Corp.
You don't want the S-Corp. If you're going to have a lot of partners, like many people, if you're going to, if for example, let's say that, Spencer, we found really a great property, commercial property in Iowa. It cost $100 million to buy, and we don't have the money right now in our pocket to pay it out of pocket. So we say, okay, we want to bring friends and family to invest with us. Let's assume that we all have the same rights, but it's more than 100, not an S-Corp. Owning like real estate in general into an S-Corp, it's a big no-no. It's not like it's forbidden, but it's a big no-no because you have like a problem with debt basis with S-Corps and limitations around basis and debt. So that's a big no-no as well.
QSBS.
You don't have QSBS when you're an
well, if you want to form a company that you foresee being eligible or you're interested in benefiting from the QSBS exclusion, you don't want to be an S-Corp.
Yeah.
So lots of
and I can think about another 10 options. It's really great if you're providing like if you're an active business and it's mostly just you, maybe a friend, your friend, maybe your spouse, family member. It's just kind of like professional services, let's say, active business. No, you're not going to buy assets into that business. You're not going to have anything fancy. Like basically the industry that generates the most amount of income for S corporations is professional, scientific, and technical services. That's kind of like the majority, which is about $70 billion of net income from that industry alone as of 2017. So it changed a bit, but that's what we have the statistics for. It's just for like basically professional, scientific, and technical services. Also management companies, kind of those are the very classical cases.
S-Corp represents a small business corporation, and so small businesses are really what the S-Corp is best for. But for the IRS, a small business is, a business doing $25 million. So if you think of it in that context, it's for those like closely held, smaller businesses.
Yeah, but definitely not such a black and white decision that maybe it's portrayed to be. It's a little bit more nuanced, depends on your situation and your future goals. Now, let's say you saw that you should be an S-Corp, you made the election, maybe on your own, or your CPA did it for you, and you regret it. What do you do then?
You're locked in for 5 years.
5 years.
Unless.
Yeah, after 5 years, you can revoke your S election, or if you do something that makes you ineligible to be an S-Corp, then your election would automatically be revoked. So if you brought in a foreign owner, if you brought in a non-individual owner, if you brought in over 100 owners, your S corporation would automatically be terminated.
But even then, even if you disqualify yourself, it really depends what you currently have in the S corp and what you have behind it. And it's like if you're a C corp, for example, and you disqualify yourself, you need to understand what are the consequences of disqualifying yourself, because it can be like very painful. Another thing, like if you, for example, if you're living in California and you have some kind of like assets for some reason in the S-Corp, which happened to one of our clients, they owned their real estate under the S-Corp and they moved away from California to another state. They needed to liquidate basically the S-Corp and move it under their name. I don't remember specifically what happened. It was a couple of years ago, but there was a huge problem there with like specifically California and the liquidation of the S-Corp. Like it's not a business structure for anybody, and a lot of clients ask us, by the way, can I make investments or can I open a brokerage account through the S-Corp? There is can and should. They're two different things. Yes, you can. No, you should not. As a rule of thumb, of course, each case depending on the disclaimer.
When you have clients asking you about an S-Corp for something that yes, you can, but no, you shouldn't, is it almost always because they hear about the avoidance of self-employment tax, the Social Security and Medicare, and they think that's for me, I need to get that?
That's an opinion. I can say my opinion, but Rachel, you want to say your opinion first?
I can say my opinion. I mean, I think with a lot of things, it's you hear about something and your first reaction is like, is that right for me? Like, I heard about this thing, sounds cool. I want to do that without really thinking about what it means for you. Something that's really great for your neighbor might not be the best answer to you for you.
Yeah.
I mean, that being said, I love S corps.
The tool.
And they
It's like
and
tool. It's
I
like a
think they
drill.
are I
Think
think they
about it like a
are
drill.
great for most businesses. They're just not great for every business, so it's a decision to make.
LLCs are cool. S corps are cooler. So
Yeah.
that's yeah, we
I
like them.
Exactly.
LLCs are way cooler than S-Corp, in my opinion. But much more
Well,
flexible, allows you to do much more. Think about it like a drill, like like a tool. Like you have a toolbox, you have a tool. You need to choose the right tool for the right job. So that's really like how you should think about it. I don't get too attached to a tool. Let's put it that way. Get attached to your goal.
Yeah.
If you want to build a house, choose the right tools to build a house. Don't just choose an S-Corp because somebody told you it's cool. So that's a
Oh.
better way to maybe think about it.
Before we move on to the next question, you had me thinking when you mentioned you got to disqualify yourself. I feel like, in the sports world, when you get disqualified, you need like some ref to come in and say, "Hey, you broke the rules. You're kicked out of the game." If you're trying to actively disqualify your S corp because you regret the decision, are you just hoping the IRS catches you make a mistake and disqualifies you, or are you proactively raising your hand and saying, "Hey, I want to DQ myself. Look, I did something wrong."
I mean, if you continued filing and you were disqualified because you have over 100 shareholders, like it's obvious that you are disqualified. Same thing with your ownership. If you didn't like disqualify yourself, the IRS would send you a letter saying, "Hey, you filed this return. It doesn't work like this." You would be expected to do is you'd file a part year return. If you had this disqualifying event on March 1st, you'd file an S corp return for the first 2 months of the year, and then whatever other return you became for the rest of the year. So at the point that the event happened, you would stop being an S corp.
Okay. Okay. Gotcha.
There are a bit less obvious disqualification. Like people are putting like stupid shit in their operating agreement. If they have an LLC and set up an operating agreement and it's two partners and suddenly they say, okay, you can do this and I can do that in the operating agreement in certain sections.
Disqualification.
That's basically you create two interest classes in an LLC. And even if you choose to be an S-Corp, the IRS doesn't have your operating agreement. By the way, you don't report to the IRS your operating agreement. That's not how it works. So this is something that can disqualify you, but you need to be responsible to report that. And if you're getting audited and somebody reviews that, they can disqualify it for you retroactively. And that's another thing that is important. So it's kind of like a double-edged sword. Needs some planning, needs to understand the consequences before you're taking a position, whether you knowingly or unknowingly disqualify yourself.
Yeah. Okay. Well, this has been a great episode. I think before we wrap, we should go through just quickly, high level, an example of a business that we would see as Gelt clients and how we would identify that the S Corp is right for them, and maybe give some numbers of this is the tax impact that can be had if you use that tool, like Tal was mentioning, in your tool belt and elect S Corp status. Tal or Rachel or both of you, if you've got, like a hypothetical.
So actually, like we have it honestly almost probably at least once a week. It happens. But let's take a physician just finished residency, started a private practice. Is going to make $700,000. The guy is an ortho bro. He's an orthopedic surgeon. So yeah, and he's working for a private practice. He's working as part of a group. He has an interest in the group, but also the group is paying him personally. So he is a great example of like somebody who should have an S corp. And generally speaking, what he will save from that, he will save basically the general what people are saying it's 15.3%, which is not accurate because it has a more complicated calculation there. But he will save about like. What it's at 12.3%, something like that. There's maybe a bit more. I should know that because I update that for 2025 for the company. But generally
But
speaking, the figure is like split to Social Security and Medicare.
yeah. And so what you're saying, Tal, is generally people are going to save on the self-employment tax, Social Security, and Medicare. But even that is nuanced. You still have to pay yourself a W-2 salary, and you do not save the self-employment tax on the W-2 that you pay yourself. And it gets even more nuanced, which I think we're going to cover in other episodes. It impacts how much you can contribute to self-employed retirement accounts. There's PTET for S-Corps in certain states. So there are other strategies that could contribute to savings. But again, not super black and white always.
The thing is that
Yeah.
you're paying Social Security up to about $170,000 of income in 2025. It changes every year. It's adjusted to inflation. But then you have the Medicare portion that you keep paying anyway for things beyond that. And that's something definitely that some people don't fully take into account, that there is no limit on the Medicare portion. So if you're making
It
700,
actually goes up.
yeah, it actually goes up over time.
I didn't know.
So-
I didn't know that.
So if you're making $700,000 and you're a Schedule C, even if you max out the Social Security portion, you probably still have about between $14 to $21,000 that you're just paying for the Medicare portion.
So let's give some numbers to the listeners just to kind of wrap this up. He makes $700,000 as a partner in this medical group. He's an ortho bro, as you call it.
Not a
What
formal term, I think. I call it that way.
What should he, and just throw out guesses, doesn't have to be exact. What should he pay himself as a reasonable salary? We know that's a requirement. He makes 700K gross. What's the reasonable salary?
There is the rule of thumb, but practically what you should have is like a reasonable salary study that have like basically a court ruling around that, generally speaking. But let's assume for this discussion that the reasonable salary is, let's say, $120,000 for this discussion.
Let's say 120. So now we're at 580. Just for the sake of our episode, he has no other expenses, which is not going to happen. But he's at 580 net profit. He's saving self-employment tax on what?
The Social Security portion on the difference between the maximum Social Security payment, which changes each year, and the W-2. So 170, let's say, 2025, one is paying 120. So there are $50,000 that he doesn't need to pay the Social Security for, and then another $580,000 that he doesn't have to pay the Medicare for.
Yeah, which is like 3% if you round up.
Almost.
Yeah.
Yeah.
A pretty significant savings there. And then also, if we assume he lives in a state where he pays a 10% state income tax, he could also do the PTET, which would help him save some federal tax. Do I have that right?
Yeah. I think a key takeaway with the S election is the more you make, the more you save. So as you're making more, your savings of having that S corporation are always increasing, because like Tal said, that Medicare limit never stops. So you're always saving. And also another great thing about particularly an LLC taxes and S corporation is you really don't have to make that decision until you know it's right for you. The IRS does allow a late S election up to 3 years after the fact. There are obviously like certain criteria you need to meet, but at least for the first year, that means you can see how you actually did and potentially understand your total cost and benefit and make that decision when you have confidence that it's right for you.
Okay, great. Well, Tal, Rachel, thanks as always for sharing your tax wisdom with us, and thanks to the listeners for joining. Hope you enjoyed, hope you learned something. If you have ideas for what you want to hear us talk about on another episode of Tax Talk Unfiltered, which we might be changing according to Tal, let us know.
We need a new name.
Yeah, we might have a new name in future episodes. But thanks for joining, and we'll be back with another topic next time.